Look, the Department of Justice is now probing valuations at a BlackRock private credit fund, and that single sentence should stop everyone absolutely cold. Not because BlackRock is going to magically disappear tomorrow, because it is not. And not because a probe automatically means BlackRock has done something criminally wrong, because that is not necessarily the case yet. Nothing has been proven in a court of law. However, the biggest problem in private credit, the absolute biggest issue in this $10 trillion shadow banking market, is exactly what they are probing. Valuations for years, there have been massive roaring questions about how these private funds value their loans, and this news just took everything up a whole notch or 10. The question every single young investor needs to ask right now is very simple. How much are all these billions of dollars in loans actually worth? And who gets to decide that number? What happens when investors, banks, regulators, and now possibly federal prosecutors stop taking those marks on absolute faith? That is the real story here. It is not just about one single BlackRock fund. It is not about one Blue Owl stock buyback. It is not about one Carlyle dividend cut or a problem fund at KKR or Apollo. The real story is that the private credit cycle is moving deeper into the dark part where trust really starts breaking down completely. And once the core issue becomes trust, the problem is no longer just about credit losses. It becomes a funding problem. It becomes a collateral problem. It becomes a massive withdrawal and redemption problem. It turns into banks pulling back their leverage, insurance companies rapidly reassessing their exposures, and ultimately, it becomes a brutal credit crunch. We have got a whole cluster of stories hitting the private credit bus right now, and every single one of them points in the exact same direction toward escalation. So we have the DOJ probing BlackRock, we have troubled funds at Apollo and KKR, we have Carlyle cutting its dividend, and of course, it could not be a day gone by without another crazy story about Blue Owl. This time, Blue Owl management is buying back 85 million in shares to prop up their stock. This is a pattern, my friends, and it is a textbook pattern of what stage 2 of a massive credit bubble pop actually looks like. Now, the reason this BlackRock story matters so much to you, even if you just invest in simple index funds, is because the entire private credit boom depended on a very simple, very seductive promise. And that promise was, hey, do not worry about daily market prices. These loans do not trade every single second like stocks on Robinhood. They do not have the same volatile price discovery as U.S. Treasuries or high-yield corporate bonds. And guess what? The Wall Street elite told you that was a feature, not a bug. Private credit managers told institutional investors that because these assets are private, because they are held to maturity, they are not being constantly repriced by panicky emotional markets. So investors were told they could earn high, stable, double-digit returns without all the stomach-churning volatility. And during the massive upswing of the cycle, when money was free and the economy was booming, that sounded fantastic. High yields, low volatility, limited defaults, senior secured status, better loan covenants, and zero mark-to-market noise. That was the pitch that raised $10 trillion, but here is the deal. The other side of less mark-to-market noise is a dark, dangerous reality. If there is no active public market price for a loan, the fund manager gets to sit in a nice air-conditioned room and model the value themselves. And once economic stress begins to rise, that financial model becomes a total game of make-believe. Because if the internal model says the loan is still worth 98 cents on the dollar, the fund net asset value looks totally fine. And the manager keeps collecting massive fees, but if a real liquid market would only pay 80 cents for that exact same loan, that is a completely different story. And if the big banks lending leverage to those funds start thinking the real number is also 80, while the fund is stubbornly saying 98, that becomes a catastrophic funding problem. If retail and institutional investors think the real number is 80, while the fund still insists it is 98, that becomes a massive redemption panic where everyone runs for the exit at the same time. And if regulators think the real number is 80, while the fund says 98, that becomes a major oversight problem. Now, if the Department of Justice is asking questions about valuations, it is already becoming something else entirely. Again, no wrongdoing has been proven. We are not sitting here saying there was explicit fraud across the board, though there has certainly been fraud in private markets in the past. We are saying that this is the precise fault line that macro critics have been warning about for years. One of private credit key weaknesses is its total absolute opacity. And the reason opacity is a fatal weakness is simply because it hides classic bubble behavior, garbage lending, loose underwriting, and the potential for serious, devastating losses. And now that beautiful opacity is really being tested as we get even more signs pointing to more trouble, always in that same direction toward escalation. Now, what Bloomberg reported for BlackRock was that the Department of Justice may be investigating valuations and specific valuation techniques at that exact fund we have been watching. And this is a monumental development, not because BlackRock is some fringe, sketchy player on the edge of finance, exactly the opposite. BlackRock is the single biggest asset manager on planet Earth, managing over $10 trillion. It is as mainstream finance gets, and that is what makes this so incredibly terrifying for the system. For the last year or so, private credit defenders tried to explain every single problem away as just some isolated case. Oh, that borrower went bankrupt. That is just one isolated case. One bad loan, that is just a one-off situation, a business development company trading at a huge discount to its asset value. Oh, that is just over emotional retail investors who do not understand finance, one fund gating its withdrawals and locking up investor money. Oh, that is not representative of the entire healthy industry. A lender letting a borrower pay interest with more debt instead of cash. Oh, that is just a normal, flexible feature of private credit, they said. But once the heavy regulatory concern reaches a fortress like a BlackRock fund, the quote, isolated case argument gets impossible to maintain. It means the critical valuation question has officially moved from short sellers, macro bloggers, and skeptical investors straight into the federal law enforcement spotlight. And that matters immensely because valuations are not just some boring accounting matter for spreadsheet geeks. Valuations are the absolute foundation for everything else that follows in wealth. Accumulation, they determine the reported performance. They determine the massive management fees Wall Street pockets, and they are the sole reason investors feel comfortable staying in the fund. Instead of pulling their cash out in private credit, the mark is the entire story. And the entire boom was built on the idea that those marks were reliable enough to trust. So the question now is not what if investors stop trusting them? The real question is how far has this mistrust already gone behind closed doors to the point that it could see the inside of a federal courtroom? And remember, this is not the only legal drama surrounding this massive credit bubble. Blue Owl is currently being sued by a major investor who is alleging the exact same thing, valuations. This is exactly why a lot of old-school investors call private credit mark to myth, because in public markets, like if you buy VU or SAG or individual stocks, there is at least a real-time price. There is brutal, honest public price discovery. You might hate the price of your portfolio on a red day. You might think the market is completely panicking, but the price is the price, it is transparent, and it is established by a fair market process. But in private credit, especially for massive corporate loans that never trade on an exchange, the value depends entirely on internal assumptions. Optimistic comparisons, appraisals, black boxes, and friendly third-party valuation firms. During good times, during bubbly times, nobody cares. If the borrower is paying cash, if defaults look low, and if rich investors are receiving their monthly distributions, everyone is willing to just smile, nod, and go along with the game. But during the downside of the economic cycle, when high interest rates start crushing cash flows, those assumptions matter a whole lot more. Which is why, as I pointed out to you guys last year, the negative economic data and softening corporate earnings are so damaging to trust. If a corporate borrower is no longer paying cash interest, and instead the interest is being paid in kind, meaning they are just adding more debt to their balance sheet, is that loan still magically worth 100 cents on the dollar? If the company is struggling and has to extend its loan maturity because it cannot refinance in the open market, should the value still be marked close to par? If the borrower earnings are weakening fast with the broader economy, but the fund claims the collateral coverage is still totally fine, how are investors supposed to trust that blindly? These are no longer theoretical questions for finance textbooks. They are questions sitting right at the center of a brewing crisis. And the BlackRock probe is important because it validates that core concern. The concern is simple: are private credit funds marking their assets in a way that reflects true economic reality, or are they marking assets in a tricky way that merely delays the painful recognition of losses? And that, my friends, is the entire ballgame. And if it was only BlackRock, that would be a huge thing anyway. But we have a whole raft of stories crashing in fast and furious all over again. Look at the names involved here: KKR, Apollo, BlackRock. These are not tiny, reckless managers at the edge of the market. These are the holy trinity, the core institutions of the global private markets machine. And this is the exact part of the cycle where the issue stops being about whether a few bad actors made some bad loans and starts to become how much of the entire trillion-dollar boom was built on assumptions that only worked when money was free and easy. During the fundraising boom, private credit managers were raising capital hand over fist, pension funds wanted higher returns to pay retirees. Insurance companies craved yield, wealth managers wanted alternative products to sell to rich clients, and retail investors were hunting for passive income, and big banks were pulling back from lending after the banking mini-crisis of 2023. So private credit stepped in to fill the void. For a time, everything lined up perfectly. But when everyone is trying to deploy too much capital into the exact same kinds of corporate loans, you know exactly where this goes. Underwriting standards inevitably weaken, and Wall Street gets sloppy. That is how credit cycles work. It is not because everyone wakes up one day and decides to be a reckless idiot. It happens gradually, slowly over time. A little more leverage here, a slightly weaker loan covenant package there, a more generous EBITDA adjustment to make a bad company look good, a maturity extension, a PIK toggle, and a blind belief that the exit market will always be there to bail them out. But then the economic cycle turns. Suddenly, the problem funds start to show up on the radar. The loans that were supposed to be as good as gold are now complicated, to say the least. Borrowers that were supposed to easily grow into their massive capital structures do not make it. The exit IPO market everyone was depending on completely vanishes. Cash flows do not cover interest payments the way the algorithms modeled. And the managers who raised all that easy money during the bubble are now stuck trying to manage a massive toxic cleanup. And that is what makes the KKR, Apollo, and BlackRock stories so incredibly important for us to analyze. It is about the absolute biggest names in finance having to deal with the ugly aftereffects of a credit bubble, and if the biggest, smartest names on Wall Street are neck-deep in the garbage, it is a massive piece of circumstantial evidence of just how much garbage there has to be out there across the entire financial system. Now, the easiest, clearest place for everyday investors like us to see this play out is in the BDCs. The business development companies, we have been tracking these from the very beginning on this channel. These are the publicly traded vehicles that private credit funds use to hold a part of their loan portfolios. And because they are publicly traded on the stock market, they allow us to see a little bit of market-based price discovery. It is indirect, sure, but it is at least an honest window into what stock investors actually think. Those private assets are worth, unlike fully locked up private funds, these BDCs have daily fluctuating share prices, regular net asset value disclosures, strict dividend policies, and public CC filings, and that makes them incredibly useful for understanding what might be happening beneath the surface of the shadow banking world. Because if the public BDCs are starting to show major stress, and let us face it, they have been for quite some time, you can bet your life savings that similar or worse stress exists inside the less transparent, completely dark private vehicles. The same macro cycle is hitting the exact same corporate borrowers, the same weak industries, the same fragile financing structures, and the same delusional valuation assumptions. So when Bloomberg reports that Carlyle BDC is cutting its dividend, and Blue Owl BDC is desperately buying back its own shares as loan values sink, those are not just isolated stock market stories. They are structural credit cycle stories about eroding valuations and dying investor confidence. It is the road to potentially toxic waste. So let us start with Carlyle. Bloomberg reported that a Carlyle BDC cut its dividend even as it flagged, get this, a quote, better credit market. That headline alone tells you everything you need to know about the disconnect. If the credit market is genuinely getting better, why on earth would you cut your dividend payment to investors? Now, there may be perfectly reasonable, fund-specific explanations. Sure, a BDC dividend depends on net investment income, portfolio mixes, realized and unrealized losses, leverage costs, and management decisions, but the broader macro signal is impossible to ignore here. BDCs are pure income vehicles. That is their entire appeal to the market. Investors buy them because they want that high, steady yield. So when a BDC cuts its dividend, that is not a minor routine adjustment. It is the fund explicitly telling the world that the underlying income engine is not producing what it used to, or management desperately needs to preserve cash capital, or the corporate portfolio outlook is not nearly as strong as the headline yield once suggested. And that is the classic trap of the private credit. Boom. The dividend cut is not just about one missing check. It is about a dangerous negative feedback loop where lower asset values pressure the fund net asset value. Lower NAV pressures their regulatory leverage limits. Lower leverage pressures their overall investment income. Lower income forces a dividend cut. A dividend cut absolutely obliterates investor confidence. Lower confidence tanks the share price, and a crashing share price makes raising new capital impossible. That is exactly how a quiet credit issue transforms into a full-blown funding crisis. Stage 2. And then, of course, we have our favorite sad bird, Blue Owl. What was reported with that one is that Blue Owl BDCs are buying back their shares in a pretty substantial, aggressive way. That matters. Blue Owl bought back 85 million of its own shares as their loan values are sinking. Now, corporate buybacks are always spun by PR teams as a great sign of management confidence. If a BDC shares are trading way below their reported net asset value, buying back shares can look accretive on paper. Management can say, look, we believe our shares are deeply undervalued, and we are just returning capital to our loyal shareholders. That is the positive, sunny Wall Street spin, but you need to be a clear, awake investor and ask the more important question. Why are the shares trading so weakly in the first place? Why are the underlying loan values sinking month after month? Why does management urgently need to use precious cash to artificially support the share price? Instead of investing in new loans, it tells you that the market does not buy the story anymore. It tells you investor confidence in those reported valuations is completely broken. And this is where the private credit cycle gets very interesting for value investors. If investors fully trusted the reported net asset value, they would be flooding in to buy the stock when it trades at a discount. But if investors suspect that the NAV itself is a total work of fiction and way too optimistic, then the stock discount does not just persist, it actually deepens and gets much worse. A BDC might claim its asset value per share is $15, but the public market might look at it and say, yeah, that is a nice number on a PDF. But we do not believe it. We think the real liquid value is $10. That is real price discovery, even if it is indirect. And price discovery is exactly what the private credit industry has tried to avoid, like the plague lately. If you have not noticed, that is why public BDCs matter so much to us. They reveal the immense tension between reported paper marks and market-implied reality. The fund may mark a loan at 95. The market values the BDC as if those loans are worth 75. And in some extreme cases like we are seeing with the fallout at BlackRock, some of those corporate loans go from 100 to absolute zero overnight, which is precisely why the DOJ is getting its hands dirty and getting involved.